Well, welcome to Chapter 13, our last chapter of the semester. In this chapter, we focus on measuring and evaluating the financial performance of companies. And there will be a few new things you learn, but one of the nice things about this chapter is that the ratio analysis you've already been introduced to in most of the chapters that we already covered. So what we're going to do in this chapter is bring the ratio analysis together with horizontal and vertical analysis to give us a better picture of how to assess the financial performance of companies. Let's take a step back now and review the goal of accounting. The goal of accounting is to provide useful information that helps decision makers. And in this chapter, we're specifically focusing on helping decision makers understand and evaluate the results of business activities. Now, we said financial accounting focuses on creditors and investors. Creditors are people that the company owes money to, and they assess compliance with loan covenants, and they assess the ability of a company to pay back their debts. Analysts and investors use financial statements to generate investment advice to decide whether they should invest in a company or not. But people inside the business, such as managers, analyze financial statements to evaluate financial past performance and also make future predictions and decisions. Okay, the first type of analysis we're going to be learning about in this chapter is called horizontal or trend analysis. And when we hear the word horizontal, we think of the word horizon, which means you're looking from one period to another. And that's what we see here. Horizontal trend analysis are conducted to help financial statement users recognize important financial changes that unfold over time. They compare individual financial statement items, both balance sheet and income statement, horizontally. That means from one period to the next. And the goal is to identify significant, sustained changes, which we call trends. Okay, now the first thing we need to do this is we need comparative financial statements. And what that means is more than 1 year so that we can compare them. First, we've got Lowe's balance sheet here. And notice that the most recent year is in the first column and the earlier year is in the column to the right. Then we've got a column that indicates whether there's been an increase or decrease in amount and the percent of increase or decrease. This is very easy to do. The math here is quite easy. It's in the analysis that we learn a great deal about the company. So to perform this type of analysis, we simply subtract the recent year minus the earlier year equals the increase or decrease. From 2016 to 17, there was an increase of 153, and these are in millions, so $153 million. We show that as a clear figure. Then we take 153, divide by the earlier year, the column right next to it. So 153 divided by 405. Then we multiply by 100 to change your decimal answer into a percent. And then we round the answer to 1 decimal place. So that's how we got 37.8%. With short-term investments, there was a decrease. They sold off their short-term investments, so it went from $307 million to $100 million. But if we kind of follow the rule, 100 minus 307 is a minus 207. And actually, that's how it's going to be entered into Connect, as a minus. Then Connect will change the answer to parentheses. So then we take 207 million, divide by 307 million, multiply by 100, and then round to 1 decimal place to get our percent. And we would do that with every single item on the balance sheet. Now, remember, when you're calculating by percents, you cannot divide by 0. So if, for example, there was a 0 here instead of 307, we could still calculate the dollar increase or decrease, but we could not divide by 0, so we would not be able to calculate a percent if the earlier year were 0. Okay, so let's take a look at some of these changes or trends. First of all, we can see that Short-term investments went down significantly. They sold off their short-term investments. Some of that money remained in cash, and then some of it went into the purchase of inventories. We also increased in other current assets. In fact, there's been a significant increase in assets here other than the short-term investments. Assets have gone up by a total of 10%. Property, plant, and equipment went up as well. Now, where did that money come from? Well, we said we sold some short-term investments, so we had a decrease there of 67.4%. But look at the debt that was taken on. Our current liabilities did increase 14.1%, but our long-term liabilities went up 22%. Now, when we see these percents, what we then do is investigate. What caused those changes? A lot of answers can be found in the notes to the financial statement or the management discussion and analysis letter, and they can tell you what happened. What happened here was Lowe's had actually issued almost $3 billion of new bonds. And with regard to stockholders' equity, they took some of the money and bought back some of their own stock. Instead of keeping it as treasury stock, they retired that stock. They permanently bought it back. Now let's take a look at the income statement. We do the same thing. We follow the same practice. The most recent year minus the earlier year equals our difference. If there's been an increase, we'll show that as a plain figure. If there was a decrease from 16 to 7, we would put a minus in connect or show it with parentheses on our financial statements. And then again, we take the increase or decrease, divide by the earlier year, then multiply by 100 to change that into a percent, and then round to one decimal place. So we can see here that there's been a 10.1% increase in sales revenue. However, the cost of goods sold went up at a faster rate than our sales revenue did, so our gross profit did not experience as much of an increase as net sales revenue did. Our operating expenses went up 6.5%. Interest expense went up, but we're not surprised by that because we did just issue $3 billion worth of bonds. Income tax does go up because when you make more money, you experience more taxes, right? So what happened to cause that sales revenue increase? Well, if we were to look at the management discussion and analysis letter or in the notes, we'd find out that Lowe's acquired a Canadian home improvement company called Rona, and they added 27 new stores. The other thing is that it was a longer fiscal year, 53 weeks, rather than 52 weeks. So that's called horizontal analysis, looking for changes over time. And we said to remember that if the earlier year is a 0, we cannot divide by 0. The other thing I wanted to mention is sometimes percents look really large, but they don't represent a large change in dollars. For example, if I told you that last year I made $1,000 on my job, and this year I got a 100% raise, and I'm now making $2,000 a year in my job. You wouldn't be that impressed because $2,000 isn't all that much. But it was a 100% increase. So sometimes percents call our attention, but when we look at the dollars, they're not as significant. But what usually causes us to begin our investigation is when we see large changes in percents. Okay, now let's take a look at vertical analysis. And while horizontal analysis is sometimes called trend analysis, vertical analysis is called common size analysis. And what this focuses on is important relationships between items on the very same financial statement. So we're working 1 year at a time. These items are compared vertically and typically expressed as a percentage to reveal the contributions of each made to a significant item. On the balance sheet, what we do is we divide all assets by total assets. each one of these numbers will be divided by total assets, and then we multiply by 100 to change it to a percent. So for example, 558 divided by 34,408, and then multiply by 100 to change it to a percent, round it to one decimal place, and that's 1.6%. Short-term investments of 100 divided by total assets, multiply by 100, then round to one decimal place, that's 0.3%. So every single one of these amounts get divided by total assets. When you divide total assets by itself, you get the number 1, right? You then multiply by 100, and you get 100%. We do the same thing for each item in fiscal 2015, but this time we divide by total assets of 31,266. Every single one of these items get divided by 31,266. We multiply by 100 and round to one decimal place to get these numbers here. Now, what do we divide liabilities and stockholders' equity by? By the total liabilities and stockholders' equity. So current liabilities of 11,974 divided by 34,408 times 100, then round to one decimal place is 34.8%. So we do the same thing. We divide total liabilities and stockholders' equity items by, or each item divided by total liabilities and stockholders' equity within that year. In 2015, we divide each of the liabilities and stockholders' equity items by the total liabilities and stockholders' equity. We multiply by 100 to change it into a percent, and then we round to one decimal place. So it shows what each of these items are as a percent of some total. On the balance sheets, it's a percent of total assets or as a percent of total liabilities. On the income statement, we'll learn that each item will be shown as a percent of net sales revenue, or if it's a service type business, it would be total revenue. So this part is very important here too. On the balance sheet, total assets and then total liabilities and stockholders' equity are set to 100%. In other words, you divide by total assets. And on the income statement, net sales revenue will always be 100% because you're dividing by that dollar value. Okay, so let's take a look at what this tells us now. This tells us that the largest percent of total assets are two categories: inventories and property, plant, and equipment. And that makes sense because they're retail stores. They're bricks and mortar stores. So property and equipment would be a large part of their assets. And what they sell, as the retailer, is they sell their inventory. Now, inventory increased as a percent of total sales from 2015 to 2016. And property, plant, and equipment actually decreased as a percent of total sales from 2015 to 2016. Now let's take a look at current liabilities and long-term liabilities. It looks like current liabilities went up slightly as a percent of total liabilities and stockholders' equity. However, long-term liabilities went up 4.5%. Stockholders' equity dropped. Now we know there's a few reasons that would cause stockholders' equity to drop. We could be buying back our own stock as treasury stock. We could have suffered a net loss, but we know that that's not the case with Lowe's. Or we could have given out some hefty dividends. Now we may have given dividends, but the main reason why we see a decrease here is we've learned that Lowe's bought back and permanently retired some of their common stock. So as a percent of total liabilities and stockholders' equity, it decreased about almost a full 6%. One more thing. Just the way the dollars have to add up, our percents have to add up to 100% here for the assets, and then the liabilities and stockholders' equity together have to add up to 100% as well. when we take a look at our income statement, everything gets divided by net sales revenue. So for fiscal 2016, net sales revenue gets divided by itself. We then multiply by 100. That becomes 100%. Cost of sales gets divided by net sales revenue. Multiply by 100 to change it to a percent, and then round to one decimal place, 65.4%. Gross profit, divide that by net sales revenue, and then multiply by 100 to change it to a percent and round to one decimal place. Notice how 100% minus 65.4 equals 34.6%, just the way the dollars subtract. And then we continue with each item. Each one of these items gets divided by net sales revenue. Within 2016, that would be divided by $65,017. And if we continue with the math, 34.6 minus 25.6 as operating and other expenses, minus 1% minus 3.2 gives us net income as a percent of sales revenue at 4.8%. So 4.8 cents of every sales dollar ends up as net income in fiscal 2016. In fiscal 2015, all of those amounts get divided by net sales revenue for fiscal 2015. So 59,074 divided by itself times 100 is 100%. Cost of sales divided by net sales revenue times 100, round to one decimal place, that's 65.2%. And we continue with each item divided by net sales revenue of $59,074. Multiply by 100 to change it to a percent and round to one decimal place. So let's take a look at this. As a percent of sales revenue, the cost of sales went from 65.2% to 65.4%. And we saw that same increase in trend analysis as well. So consequently, as a percent of every sales dollar, our gross profit dropped a bit. But look, our operating expenses actually dropped as a percent of every sales dollar. They exhibited greater control over operating expenses. Interest expense went up as a percent of every sales dollar because of those new bonds that we issued. Income tax stayed the same as a percent of every sales dollar. So because of the greater control over operating expenses, 4.3 cents out of every sales dollar was how much we made in 2015. In 2016, we made net income of 4.8 cents out of every sales dollar as net income. So now I'm going to do a demonstration of E13-3 using horizontal and vertical analysis.